This is Adam Laibson. Welcome to the Mainsail Financial Group Podcast series, where we host industry experts and local professionals to talk about their areas of expertise and provide some guidance into different areas that we do not normally focus on day to day. However, today is a little different. Today, we're going to welcome Brandon Steele, the co-founder of Mainsail Financial Group, from the interviewer chair to the interviewee chair. And we thought it would be a good time to talk about something that you hear about in the news almost every single day. And that's the I word in the economy right now. You guessed it, inflation. So I think today we're going to have a great conversation. And Brandon, if you're ready, I think we might just jump right into things.
Yeah, that sounds good. I think it's good. It's funny to be on this other side. I feel like last time we did this was basically a year ago, wasn't it? Right when the pandemic kicked in.
I think that's right. I think that's exactly right. So year goes by in a blink.
Yep. Fun to do this with just us two again here.
Absolutely. So maybe start us off with something relatively basic. Maybe you can just define what is inflation? What does that term mean?
Sure. And I think maybe the easiest way to put this in perspective is something that maybe we all are familiar with. So, I guess maybe I'll since I still don't have a ton of years behind me, I'll use the movie ticket example. If we think back to I go back to high school, for instance, or middle school, and think about how much a movie ticket cost me back then. Back in the day, it was maybe like $5 to go to a movie. Fast forward to here where we are in 2021, and it's like, I think it's almost $20 now to go to a movie. And that doesn't include popcorn or the Pepsi or the nachos that you want to get at the theater as well. So in short, that is inflation, right? It's things getting more expensive, or if you want to think about it in reverse, it's a dollar buying less. And I think maybe the easiest way to kind of define this or sum it up more simply is basically too much money chasing too few goods. That's what starts to cause these inflation considerations.
Got it. One of the things that I've heard as a sort of I don't want to say a rumor, but kind of maybe a misconception out there, I'm hoping you can clarify, is that some inflation is good. A lot certainly isn't good because we will feel that right away, but a little bit's okay. I'm wondering if you can maybe share a little bit more about that. And to me as a consumer, like, what does inflation actually mean to me?
Yeah, I think this is a really good place to kind of kick off our conversation. And especially with so it's August 2021, and the Fed is like constantly in the spotlight here lately. So I think that's where a lot of that comes from. I think especially lately, like that is the narrative that inflation's a good thing. And you hear the Fed talking about chasing this 2% inflation rate. But it's really interesting because, nowhere do I see in history that points to inflation being a good thing for the consumer or a good thing for the economy in general. Generally speaking, if you can share with me how higher prices are good for anybody, I'm not quite sure how that all pans out. So, it's really interesting because all of a sudden that has been the narrative of like, let's aim for 2% inflation. We want this certain level of inflation. And that's when the Fed says they're going to start making changes. But I just don't, I guess from my perspective, I'm not sure why we're chasing that in the first place. And, as far as what it means to you or to anybody listening, generally, again, inflation means higher prices. And so, when we start to hear all this news that we're hearing about the inflation rate picking up and what's going on, generally what it's going to mean is things are going to cost you more. And so, getting ready for what that may mean for your planning, but also, your investments in your portfolio as well.
Sure. So I'm wondering if you can maybe add a little context to this. So we know that inflation is a little bit higher right now. We hear about that almost everywhere you turn. So what actually is the current inflation rate? And if you can predict to some degree, what do you think that inflation rates are going to look like going forward? What do you expect them to look like?
Sure. Maybe before I jump into the current, I want to maybe step back and go all the way back to basically when we did this interview last, Adam. So obviously, during the pandemic, right, we were all kind of locked down. Where were we spending our money?
Well, we were spending it on things that we buy to be delivered to us at home.
Right, exactly. Where were we not spending our money?
Everywhere else.
Yeah, right. Like traveling, like the going out to eat, right? Those types of things. So, it's really interesting because inflation's been something that, as you know, we've been watching for a very long time. And I think the challenge is that the numbers are starting to show it. But if we go back a year, honestly, a year ago, there were already some signs that inflation was picking up. We started to see things like food getting more expensive, the price of meat, the price of lumber. A lot of these things that we were actually spending our money on were growing and growing very quickly. The challenge was that from the way that the CPI or the measure of inflation is kind of handled is there's a basket of goods. And so it doesn't just look at one area, it looks at kind of a broad area of the market. So what we weren't spending on, the traveling, the airfare, right, the hospitality, that kind of thing, obviously was not increasing. And so we saw the areas we were spending on really pick up, but this was keeping that inflation number down. Fast forward to what, I don't know, probably 6 months or so ago. And now we're starting to get out more, right? People are getting back out traveling. People are going to go visit family, visit friends, that kind of thing. So the other half of that equation has picked up, has caught up. And so now we're really starting to see that in the inflation numbers. To maybe give you a second part of your question there about like kind of where we're at, the most recent numbers are at about 0.5% per month. And that's been the case, I think, 2 or 3 months looking backwards now. So if you annualize that, that's a 6% annualized inflation rate. That trend will continue, which obviously is much higher than we've been used to lately.
Sure, much higher. And so do you, I guess this is a two-part question. Do you expect that to be short-term? Will we go back, do you think, to some period where inflation was much lower? And along with that, maybe this is a place to address one of the terms that you hear about in the news is that inflation right now is just transitory. Can you maybe share a little bit of light on both of those gears and how they mesh together?
Yeah, transitory. I feel like that's in everybody's dictionary now. So let me break this apart real quick, because I think there's two forces at work with inflation right now. The first is kind of where it all maybe started, which is the money supply. So what happened is in the past year, we've increased the amount of dollars in the United States by about 25%, right? So all else remaining equal. And again, this is a very simple version of a very complex scenario. But if nothing else had changed, right? If the money supply increased by 25%, that means that really inflation's got to pick up by 25% in order to even us out, right? If I have $10 to my name and the only good in the world is, a pair of shoes, if it cost me $8 before, well, if that's the only thing out there, I'm eventually going to end up paying $10 for that pair of shoes. So that's how that side of it works with the money supply. Again, bear with me because there's a lot more to it, but just very simplistically speaking. The other side of it is the supply and demand, right? So what happened is we turned off this giant machine called the global economy, and we're trying to turn it back on now. That doesn't just happen overnight, right? It's going to take some time for some of the supply issues to kind of work their way through. I mean, the supply chain's been something that's been in the works for, hundreds and hundreds of years. And so to get that back fully up and running is going to take some time. So right now, like if you look at the car market as a good example, used cars are going for just these crazy prices because there are not enough new cars on the market for people to buy. So they're going to the used market. So, I mean, that's a good example. And the reason that's happening is because the chip shortage, for instance, in the car market, there's just not enough to meet the demand of the consumer right now. So sorry for this being so long-winded, but to answer your question, I think that because there are two sides of it, there's going to be two aspects. That short-term part of it might be that supply side of the equation, right? If supply picks back up and we can get that back up and running, sure, we can call inflation transitory. However, there's the money supply, and that might be a little longer, might take a little longer to work its way through. So what I kind of expect is inflation might run at a higher rate for a while, very quick clip, and then kind of pull back, but still be much higher than we're used to. So, I guess, Adam, would you call that transitory or temporary?
Yeah, parts of it, right?
Yeah.
I mean, I'm just thinking about my own experience too in a grocery store. I don't remember a time when grocery prices went up and then suddenly just unexpectedly went back down again, right? At least not dramatically. So it's a very good point. So however this goes, however inflation kind of works itself out over the next 12, 16, 18, 24 months, what, as an investor, as a financial planning person, someone paying attention to what's going on, thinking about retirement and what I'm doing, what can I do to make sure that I'm as protected as I can be, as aware as I can be, as proactive as I can be? I mean, what are your thoughts about that?
I think like the easiest way to sum that up is to be investing. If you're sitting in cash right now, as you know very well, you're paying like 0.000 nothing, right? You're not getting any money for your cash on the sidelines. So, if you start to pile inflation into that equation, what it really means is you're going backwards by whatever the inflation rate is every single year. So, I think really investing is the key to that, and making sure that you're getting some growth so that your dollars will keep up with that inflation rate.
Gotcha. So as far as places to go where my money could potentially grow to outpace inflation, it's still the markets, right? I mean, it's still kind of the place to be.
Yep. Yeah, I think so. Definitely equity markets. And, obviously there's some areas that may be better than others in inflationary environments, but yeah, definitely starting there.
So that's a good transition to my next question. So what areas of the market, are there certain areas of investing that typically perform better during inflationary periods, or things we want to stay away from? Just generally?
Yes, definitely. I'll start with the happy side of it, maybe areas that you can look at. And really it's anything that tends to grow as prices grow. So, generally some good examples are things like commodities, right? We've seen what's happened with things like oil prices lately, commodities and energy. We've seen what happened with lumber prices, which has just been this crazy story. And then maybe more simplistically or a little more boring maybe is things like, like consumer staples, right? If you have a certain amount of money and all of a sudden tomorrow, it's not worth as much, are you going to give up the pair of shoes or the, dinner for your family? Probably a pair of shoes, right? So this is where things like consumer staples, think groceries, think like Schmuckers, think those types of companies, those can do generally a little better during these periods because people are still going to need to buy those regardless. But if their dollar's not going as far, they may give up some of the more fun purchases.
Right. Sure. So I want to add something else into the conversation here. So at the beginning, when I teased the I word, I'm sure most people thought about inflation, but there's another I word, which is interest rates. And I'm curious, what impact on interest rates will inflation have? And even the reverse question, as interest rates move around, potentially keep moving up here, what impact does that have on inflation? Maybe you can share the relationship between the two a little bit.
Yeah, absolutely. That was a great segue there.
You did that. That was yours.
Yeah, I think that's really important because, and this actually answers the second part of your question a minute ago too, which is like, what are the places to be concerned around? And bonds are typically where that is. When you hear a lot of people having concerns about inflation, a lot of times it's because they're worried about how it's going to impact their bond portfolio. The reason for that is that as inflation expectations rise, interest rates generally do as well. So what does that mean? So basically, if you think about a bond as like a machine, right? If you have a machine paying you 3% every year like clockwork, and then a new, bigger, faster, stronger machine comes out that pays you 5% every year, if you were to be holding that 3% one, how are you feeling?
My feelings are getting hurt.
Right. So if you were to go sell it, you're going to get more or less for it.
Probably less for it, I would think.
Yep. So basically, that's how bond prices work. Now, again, this is very conceptual, but generally, as interest rates rise, bond prices actually fall. And so you've got this kind of like dual factor applying to your bond portfolio, where not only are we worried about the Fed increasing rates, but now inflation is starting to maybe bring the markets up as well. And that just means your bond portfolio generally may go the other way. So it's really important to watch, especially for those who are closer to retirement and starting to manage risk a little more thoughtfully.
Sure. Well, and so actually this is a really good transition to the next question I wanted to ask you, which is really about how do we fold all of these ideas and concepts into financial planning? Like, what are some of the considerations that we need to be making now in preparation for some of these, scenarios that you're describing?
Yeah, I think hopefully, I think we do this very well, but it's making sure that you have these assumptions already kind of baked in. A lot of the challenges with some of the general calculators out there and things like that is that they either assume an inflation rate for you or don't give you much guidance on what to expect. And I think that the inflation rate you're assuming in your planning is really, really important. Not only, so we talked about kind of the basket of goods that measures inflation. So not only for this period where inflation's higher, but generally speaking, that has been a little conservative, to say the least. Generally it doesn't include things like healthcare and, oil prices and things like that. So it's generally, we would suggest to be a little more conservative on that side of it when you look at your inflation expectations. And even more so now, right? When we see these periods, if these really start to eat away at your savings, the more proactive you can be and assuming a higher rate, the more you can be prepared for these types of situations when they come up too.
Sure. That makes sense. Very good. Very good. So what else? Any last things that are important for all of our viewers and watchers to know about primarily inflation, but maybe interest rates as well?
I don't think so. I think maybe that's a good place to wrap up, but
Sure.
But I do think it is something important to watch. And, although you'll hear that word transitory, keep an eye on that, because it may be transitory for a while, but I still think that we're going to see a higher period of inflation for a little longer than maybe the Fed might be leading us to believe.
Sure. Absolutely. Well, if any of our viewers had some specific questions for you and wanted to reach out, what's the best way to do that, Brandon?
Yeah, they can email me directly or email us directly, info at mainsailfg.com. Maybe also check out our website, www.mainsailfg.com. And probably better, we do a lot of content on our LinkedIn and our social platforms. So follow me on LinkedIn. I try to post out there a lot to kind of catch you guys up on these inflation topics and market updates and things like that. So I think those would be some great areas to take a look.
Fantastic. Well, thanks, Brandon, for your time and your expertise as always. And thank you, everybody, for watching and tuning in. And we will see you on the next episode of the Mainsail Financial Group Podcast.